What's up guys, and welcome back to Wall Street Millennial. On this channel, we cover everything related to stocks and investing. It's no secret that China's real estate market has been under tremendous stress for the past 6 months. It started out with liquidity issues at Evergrande, which is the second largest developer in the country with over $300 billion in liabilities. Contagion quickly spread across the industry, with fellow property giant Kaisa also on the brink of bankruptcy. Since then, Chinese real estate companies have been falling like dominoes. Major developers are announcing liquidity issues on a nearly weekly basis. Of the major publicly traded developers, all of their stocks are in the red for this year, with some of them falling as much as 70 to 80%. The latest shoe to drop is a company called Shimao Holdings, which sold roughly $50 billion of real estate last year. Their stock price has fallen 85% since August. They are now facing severe liquidity issues. In an attempt to raise cash, they are attempting to engage in a highly questionable related party transaction. Last year, the Chinese government implemented their 3 red lines regulation, which limits the leverage ratios on property developers. This was designed to decrease leverage and increase financial stability. The first developers to fall were the most heavily indebted ones like Evergrande, whose leverage was far in excess of the 3 red lines. But Shimao was compliant in all 3 of the red lines, so it came as a big surprise that they are now also on the brink of bankruptcy. Contagion has spread across the market, and otherwise healthy developers are seeing sharp declines in sales, and many of them are facing financial distress. In this video, we'll look at the fall of Shimao, what they are doing to try to raise cash, and how far the Chinese property meltdown will go. Founded in 2001, Shimao grew to be the 13th largest property developer in China, with roughly $50 billion of sales last year. They also operate luxury hotels, mostly in Shanghai. As of June 30, 2021, Shimao had about $100 billion worth of assets and $74 billion of liabilities. This gave them $26 billion of shareholders' equity, which is a pretty good position. They were also compliant with all of the government's maximum leverage ratios. The problem is, the majority of their assets were inventories of unfinished and finished properties held for sale. If the property market goes south and they can't sell their inventory for as much as they expected, they can move from solvency to insolvency very quickly. And it looks like that's exactly what is happening right now. Recently, they were trying to sell 93 apartment buildings in Shanghai to homebuyers. However, after the buyers agreed to purchase these properties, legal issues arose, making it impossible for Shimao to transfer ownership to them. As it turns out, these properties they were trying to sell had already been pledged as collateral to one of Shimao's creditors. Selling them would breach their contract. They ended up canceling the sales, and they say they will help the buyers fairly resolve the situation. But this development is highly concerning. The fact that Shimao was trying to sell properties they are not legally allowed to sell indicates that they are having serious liquidity issues and are desperately trying to raise cash. In addition to the failed property sales, there is a questionable related party transaction that brings further concern. The transaction was proposed this past Monday, December 13th. The Shimao Group has multiple subsidiaries which are listed separately on the Shanghai and Hong Kong stock exchanges, but are all effectively controlled by the parent company. Their Shanghai Shimao subsidiary is the one having problems trying to sell properties that were already held for collateral. It's pretty clear that they are short on cash, so they agreed to sell some of their property management assets to Shimao Services, another subsidiary of Shimao Group, for $267 million. JP Morgan downgraded both stocks, saying this related party transaction is suspicious, as it basically entails the right hand giving to the left hand. Shimao Services engages in property management services. It does not develop or sell real estate. Providing property management services is far less capital intensive and risky compared to property development, so Shimao Services was perceived as much safer than Shanghai Shimao. But by forcing Shimao Services to buy assets from Shanghai Shimao, the parent company is basically using one subsidiary to bail out the other. This type of transaction is a major red flag, as shareholders of one subsidiary effectively end up holding the bag for the other subsidiary's debt. Also, the $267 million price tag is likely just some number that the parent company made up. The fact that they had to sell it to one of their other subsidiaries may indicate that they wouldn't be able to sell it to an unrelated company for this price. On the news, shares of Shimao Services fell by more than 30%. Shimao Services shareholders feel like they're getting the short end of the stick because cash is effectively being transferred from them to a different subsidiary which is in financial distress. The deal has already sparked scrutiny from the Shanghai Stock Exchange, which recently ordered Shimao to explain the rationale for the transaction. It's very possible that the deal could be blocked by the regulators. If this happens, Shanghai Shimao will find itself in hot water, as they'll need to find another way to raise cash. Things aren't really looking great for the company going forward. They have $4.4 billion worth of bonds maturing within the next year, and an almost $400 million payment this coming January. Fitch Ratings recently downgraded Shimao's bonds to BB. This means that they believe the company has major ongoing uncertainties and exposure to adverse business, financial, or economic conditions, which could lead to inadequate capacity to meet financial commitments. You can also see this in Shimao Group's stock price, which is down 85%. By this point, it's pretty clear that there is major contagion across the Chinese real estate sector. The rapid declines in share price is uncannily reminiscent of the share price action of the large investment banks during the global financial crisis. While a few investment banks went bankrupt, most of them were saved at the last minute by unprecedented government bailouts. Surprisingly, the Chinese government has not indicated that they will bail out Evergrande or any of the other major property developers. This fear was confirmed as they recently allowed Evergrande to fall into technical default. Evergrande's creditors have already started suing Evergrande. With the company being so large and complicated, the case could get very messy and stay in bankruptcy court for years. These types of disorderly bankruptcies are disastrous for the economy. Typically, the majority of workers are laid off while the company's assets stand in limbo. And if the government continues to hold out on any bailouts, it won't just be Evergrande. We would likely see Kaisa, Fantasia, Shimao, and countless others also go bankrupt. And the pain won't even be contained just within the real estate sector. Many Chinese banks and insurance companies are major creditors to property developers. For example, Minsheng Bank has lent roughly $5 billion to Evergrande. This is roughly 15% of the bank's market cap. Fears around real estate exposure has caused its stock price to tumble this year. With real estate accounting for roughly 30% of the Chinese economy, almost all Chinese banks have significant exposure to the sector. A complete meltdown of the property developers would almost certainly cause severe stress and possibly lead to insolvency for many of them. The more things unravel, the worse and worse it's going to be for the Chinese economy. The 2008 financial crisis started in the US but was exported across the world because financial markets are so interconnected. Fortunately, China's financial markets are far more closed off than America's. Most of the real estate-backed securities are held domestically, so there is limited scope for contagion to other countries. But while China's financial markets are closed to the rest of the world, contagion can still spread throughout the real economy. China is the single largest consumer of many commodities such as steel and copper. Much of these commodities are used in real estate construction. For example, steel prices have increased rapidly over the past year, reaching as much as 80% above the pre-pandemic levels. But in recent months, demand has cooled down. If China's real estate sector continues to collapse, there could be a lot of further downside. But on the bright side, the US economy is mostly consumption and services based, so a decline in commodity prices would be unlikely to have a substantial impact on the economy. But it could have a serious impact on many South American countries that rely heavily on exporting basic commodities to China. Shimao was the latest shoe to drop, but Chinese real estate woes are far-reaching. And in the absence of government bailouts, we'll probably see a slow bleed of more and more developers failing in 2022. Alright guys, that wraps it up for this video. What do you think about Shimao? Is their proposed inter-subsidiary transaction appropriate? Let us know in the comments section below. If you enjoyed this content, make sure to hit the like button and subscribe so you don't miss future uploads. As always, thank you so much for watching and we'll see you in the next one. Wall Street Millennial, signing out.